Hello from the Financial Times newsroom here in New York. Markets are at an important juncture this week as we count down to Friday's all-important non-farm payrolls report for April. After a harsh winter which has severely hit the US economy during the first quarter, we are now about to see whether or not the much heralded and anticipated spring recovery in the economy is about to take place. Economists expect 215,000 new jobs were created last month. That is up from the average of 183,000 for the past 12 months. But is that really going to be enough to push equity markets to record highs and put some pressure on very low-yielding Treasury bonds? I'm now joined by my colleague Vivianne Rodrigues, who's our capital markets correspondent for the FT. So just how important is Friday's data?
Well, it depends on which quarter of the market are you talking about. Obviously, for bond investors, right, it all depends on which kind of impact you're going to have on the 10-year Treasury note. I mean, we've seen that because yields have been so low, this has given almost like, a more borrowed time for corporate borrowers. Issuance has been at very high levels and people have been it's a very friendly market. So obviously, if the report is a good report and we see the 10-year Treasury note moving higher, the question is, are bonds going to keep outperforming? Is issuance going to remain that high? Probably not.
Now, the big key thing here for the equity market, of course, is when are we about to see leadership turn to the so-called cyclicals, or the sectors that are economically sensitive. And this includes financials, consumer discretionary, which has lagged quite notably this year, along with technology stocks, which have taken a bit of a beating since March, but seem to have started to come back in the last week or so. Do you think a 215,000 jobs report would be enough to sort of get those sectors accelerating?
Well, obviously, if the economy shows signs of a real pickup, especially in the job markets, with potentially wage gains, price appreciation, so certain sectors, they are less defensive, right? I mean, tend to appreciate. I mean, people will start, well, if the consumer is going to earn more money, consumer is going to spend more money, so maybe I should leave some of these very defensive, especially the banking and stuff like that, and start actually moving to high growth, potentially, stocks that have higher beta and higher potentials to grow through the end of the year.
And the other important thing about what we're seeing in markets at the moment, of course, is that very low bond yields have helped finance what we see a big pickup in M&A activity. So if we do see stronger data, I mean, how far do yields rise before we start to see perhaps M&A deals start to sort of be affected by high costs of financing?
But that's a $1 trillion question, right? Everybody keeps debating at what point does the 10-year Treasury note yield get so high that the cycle turns. So today, for example, we were talking to people at Lumisale, Dan Fuss, and he mentioned that a 10-year note yield at 4.25%. And that's it. I mean, the cycle has turned when we get to that level. So definitely a much less friendlier market. When it comes to M&A and all these deals, we've seen that the bond market has been very friendly. So a lot of companies said, well, maybe I can buy a company, finance myself through the US bond market, and there's so much demand that I can do that easily. Obviously, when rates start getting close to 4%, that may not be the situation.
Well, the 10-year yield is some way away from that 4% threshold, and it'll certainly take some very strong data in the coming months to push yields substantially higher from their current levels. So again, all eyes are focused on Friday's non-farm payroll report and whether or not we are going to see the spring rebound.